Hi, this is Seth David from the world-famous Nerd Enterprises Incorporated, bringing to you another special screencast. This is the first one in weeks because I have been buried, but I'm finally coming up for air after tax season. I have to think of something very special to do on tax day this year. Every year I try to do a special webcast on tax day, so check back for that. But this one, we're talking about how to account for contributed capital using QuickBooks. What does that mean? It means that when I have a startup business, unless I have a syndicate of investors who can give me lots of venture capital to make my idea happen, then I might be left to my own devices, and for that matter, even somewhat at a loss for how to get started with the capital I need. Now, let's say I have a little cash. Then great, I take cash out of my personal account and I make the contribution into the business account. That's easy, and the way we account for that is by simply going to banking and make deposits. And as you've no doubt read in the blog post, we would book it to shareholder contributions, and let's say we're contributing $3,000. Very simple. To record a cash contribution is very easy. As always, we want to look at the balance sheet when we record these things so that we can see what it looks like. I've got a fresh company file here with no prior transactions recorded, so everything's blank. As soon as I hit save and close on this, and tell QuickBooks that it's okay to refresh the report, there's my $3,000 in the bank account, and there it is in the equity section under shareholder contributions. Now that's easy, but let's say that what I've contributed instead of cash is something like services. And the example we use in the blog post, and if for some reason you didn't see the blog post first, the link is obviously going to be posted wherever this video is. Let's say that in order to get started, like my friend Josh, who really inspired this video, let's say that we contributed web design services. The first thing we have to do is put a value on those services. We have to decide how much is that worth. Well, let's say that normally I would go out and bill a client $150 an hour for web design services, and let's say that the particular project of setting up the website for our company took 20 hours. So of course that's the same $3,000 contributed capital, and now we know how much to record. The question is, how do we record it? Because no money is actually going into the bank account. And the way we're going to do that is we're going to do that with a journal entry. So we come over to Company, and we go to Make General Journal Entries. And let's widen this up a bit so you can see everything very clearly. And let's start with the easy part first. We know how much the amount is. The hard part is, which accounts does this go to? And the thing to think about, as I pointed out in the blog post, is to break the transaction up into its components. If I wasn't contributing this, theoretically the company would have to go out and pay somebody for it. So we'd write a check or we'd enter a bill and then pay that bill for the $3,000. And when we do that, we would book it to web design expense, or web design services, or however you like to title it. Let's call it web design services for our purposes today. And I'll quickly set this up as an expense account. So that's going to be our debit. We're going to create web design services because we want to reflect the fact that the company has in fact incurred this expense. Even though it didn't actually pay for it, it still is an expense that the company had to incur. And then the question is, how do we incur it? Again, we made a contribution. So the other side of that is going to go to shareholder contributions. Now, of course, in a second, when I book this, it's going to double the amount because we've recorded the $3,000 cash contribution. Now we're going to record this service contribution, for lack of a better word. And you might want to put a comment on here, a nice detailed comment explaining that these were services contributed by the owner. Save and close. My balance sheet updates. Now I have $6,000 in contributions. Notice I have $3,000 in a net loss or net income flowing over to the balance sheet from the P&L, which you can't see because I've just recorded a web design services expense on the books. Now the last part of this is, what if I've contributed property? Let's say we contributed computer equipment, and let's say that computer equipment, for argument's sake, was worth $4,500. This way we use a different number. Again, we're going to want to make a journal entry because, again, we're dealing with a situation where something happened on the company books that didn't affect cash. So I can't write a check, I can't record a deposit because nothing happened that goes through the bank that affects the bank account. So whenever that happens, it's really a journal entry that you're going to have to use in order to reflect the transaction at its appropriate value. So let's say we donated $4,500 in computer equipment to the company. Not donated, but contributed is really the better term. In this case, we're going to have a fixed asset, and let's see what we've got on these standard books. Furniture and equipment. We might even have a separate category called computer equipment, and we can quickly set that up and add it in as a fixed asset. And that's what it's going to be because it's a major purchase. Even though it's not a purchase, in this case it's a contribution, but the point is we want to put the value on the books on the balance sheet as a fixed asset so we can depreciate it. And once again, the credit side of the journal entry is always going to go to shareholder contributions. When we're doing just that, we're making a contribution into the business. Notice when I hit save and close, it's going to affect the balance sheet. We're going to have the fixed asset on the books. We're going to have the additional shareholder contributions. So now we have a total $10,500 in shareholder contributions, computer equipment, and fixed assets on the books at $4,500, which will get depreciated over a period of 5 years, or if your CPA or tax preparer prefers, they will elect Section 179 and depreciate the whole thing in the current year. Either way, it should go to fixed assets first. You should not expense an amount this large. Web design services is not the sort of thing that we perceive is going to produce a benefit over a long period of time. In fact, if anything, as you probably well know, web design, you're going to change your website constantly. So those types of expenditures get expensed. You know, the benefit is probably derived within a year's time. And that, my friends, is how you account for contributed capital using QuickBooks. As always, I do hope you're having an absolutely fantastic day. I hope you've learned something. And please, 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 post your comments and questions below. Best comment or question gets a free nerd t-shirt or pen or something. So go ahead, post your comments. Let me know what you think. Let me know how you're doing. Let me know if you love my blog, if you hate my blog. Just talk to me. I'm lonely. I'll speak to you soon. Have an absolutely fantastic day.